The Consumer Price Index just landed at 330.293 for March 2026. That is not a typo. That single number represents the highest CPI reading in this entire dataset. And it tells a story the mainstream headlines are completely glossing over. Stick with me for the next 5 minutes, because this data has a direct line to your mortgage payment, your grocery bill, and whether the Fed cuts rates before the end of this year. Let's start with the headline number. CPI-UCSL came in at 330.293 in March 2026, up from 327.460 in February and 326.588 in January. To put that in perspective, back in April 2025, the index sat at 320.302. That means, in roughly 11 months, the all-items CPI climbed nearly 10 full index points.
That is not the story of inflation dying.
That is the story of inflation grinding higher, slowly, persistently, month after month.
Now here is where it gets more alarming.
Strip out food and energy. What economists call core CPI, tracked as CPILFESL, and you get 334.165 for March 2026. Core CPI is actually running above the headline number. That matters enormously, because core is the metric the Federal Reserve watches most closely when deciding whether to move interest rates. Core was at 326.467 back in April 2025. It has now climbed more than 7.5 points in 11 months. The Fed cannot look at 334.165 and call this problem solved.
So what is the Fed actually doing?
The effective federal funds rate has been locked at 3.64% since January 2026.
4 consecutive months without a single move.
Compare that to where rates were just last summer, 4.33% in May, June, and July of 2025. The Fed cut aggressively through the fall, dropping to 3.72% by December, and then stopped cold, with the CPI now printing at 330.293 and core at 334.165. The data is making it very hard to justify another cut. The Fed is caught between an economy that wants cheaper money and an inflation reading that says it is not time yet. Now let's connect this directly to the housing market, because this is where everyday Americans feel the most pain. The 30-year fixed mortgage rate, as of April 30th, 2026, sits at 6.3%. That is not a relief rally. Earlier in the spring cycle, the rate briefly touched 5.98% on February 26th, the closest thing to a break buyers have seen in years. But since then it has climbed back up.
6.0% in early March, 6.11%, 6.22%, 6.38%, and then spiking to 6.46% on April 2nd, before settling back at 6.3% on April 30th. Every time buyers think rates are coming down for good, the CPI prints another hot number, and mortgage rates snap back up. With CPI at 330.293, there is no fundamental reason for mortgage rates to fall meaningfully in the near term. Here is what this means for the stock market. Equities have been pricing in rate cuts all year, but when you look at the Fed funds rate frozen at 3.64% and core CPI at 334.165, you have to ask, what exactly are stocks pricing in? If the Fed cannot cut because inflation is still running hot and mortgage rates stay elevated at 6.3%, consumer spending on big-ticket items gets squeezed. We have already seen warning signs flash from consumer-facing companies. The CPI data at 330.293 is the macro confirmation that those warnings were not noise. They were signaled. So what should you actually do with this information? First, do not expect mortgage relief soon. With the 30-year rate at 6.3% and CPI still climbing, any dip in rates is likely a head fake, not a trend. Second, watch the Fed's next statement extremely carefully. 4 months at 3.64% with a rising CPI is a policy standoff, and something eventually breaks the stalemate. Either inflation cools or the economy forces the Fed's hand. Third, if you are in the stock market, the sectors most exposed to consumer spending and interest rate sensitivity deserve a second look right now. The CPI at 330.293 is not a number you can ignore. The bottom line is this. March 2026's CPI reading of 330.293 is the highest in the dataset we have. Core inflation at 334.165 is running even hotter than the headline. The Fed has been frozen at 3.64% for 4 straight months, and mortgage rates just closed April at 6.3%. Every one of those numbers is connected.
Every one of them affects your financial life. The inflation story is not over. It just entered a more dangerous and more complicated